Well, good evening. I am Renee Price, and President of Democratic Women, and we also are very concerned about elections and anything that deals with women, because we still don't have the Equal Rights Amendment. We are still getting paid less than men. and many other things, and so I think we are an affiliate of the Democratic Party, and I think many of the issues that we're concerned about really overlap with progressive Dems anyway. So it's wonderful that we can actually come together on this evening to hear more about our tax system. And my job this evening is to introduce Lee R. Nackman, who is a retired computer scientist and executive. He holds a Ph.D. in computer science and has published academic papers, built software products, and co-authored a technical book. As an executive at IBM, Microsoft, and HP, he managed large global teams. He also led product development in 10-person startups and served as advisor or board member for several small companies. And so this evening, he is going to tell us how our tax system really works, help us to understand the large tax breaks that kind of slip under the radar, and I guess he's going to have some solutions for us. If that is so, I think we need to put him on the ballot. So it's my pleasure to introduce to you Lee Nackman.
Thank you, Renee. So one of the things that Renee didn't say is Lee is a tax lawyer or an accountant or anything like that. I'm none of those things. So I can't give you tax advice or whatever. But I have gotten very interested in how our tax policy affects our politics and affects our people. And if you followed the last presidential election, you would have heard Bernie say our tax system is rigged. And what does that mean? And how is it rigged? So what I hope to do is to help you understand those things. If I can get back to the little thing there we go. So I'm going to talk about these topics. The first thing, I'm going to talk very briefly about what makes a good tax system. What would we like in our tax system? And then really, I think it's such a complicated, large topic. I'm going to talk to you about where the money is, and let's follow the money. We'll look at some of the big ones, but there's lots of other ones that we'll skip. And it turns out that I'm going to talk about Social Security payroll tax, sales taxes, which should be on a separate line but are not, and federal individual income taxes, because they're the big money ones, okay? And then I'm going to talk to you about what are called tax expenditures, which are kind of the big tax breaks that are in our tax system. And I'll show you how big they are and who gets the benefit. I'll talk then about the proposed amendment, which Renee said is not good, but I would say it's bad. Okay, so I'll try to explain why I think that's the case. And then I'll talk to you about some ideas for improving the tax system. I would like to try to go through this without a lot of interruption. So if you can hold your questions, that would be great. But if you don't understand, if I'm saying something that's not clear, please interrupt for clarification. But let's hold discussion and sort of extension questions until we get through the material. Okay? So let's talk about what would make a good tax system. First of all, let's face it, our situation and our politics change over time. So you'd really like a tax system that can be flexible. If we have a recession, maybe our tax system needs to behave differently than if we're in an economic boom. If conservatives are in power, they might want to adjust the parameters of the tax system in a different way than if liberals are in power. You'd like a tax system that's flexible enough to do that without having to constantly change the tax system. You'd like it to be simple and transparent. You'd really like to be able to understand it. The number that's thrown around, which I don't think is really correct, is that there's 76,000 pages in the US tax code. Whatever the real number is, it's a big number. It's very complicated. And you'd like it to be transparent. I'll get back to that in a minute. You'd really like to be able to make statements about the tax system and to understand whether they're true, to understand how the tax system works, and that's very hard to do now. And finally, you'd like the tax system to be fair. So let me talk about simple and transparent. So here is one of our leaders, Paul Ryan, who says, we're making things so simple that you can do your taxes on a form the size of a postcard. So he said that as the discussion about tax reform was going on. And they put together a simple tax reform bill that is 1,097 pages long. So you judge whether you think it's simple or not. The complexity, the problem with complexity, other than just the mass of stuff that people have to deal with, is it makes it really easy to lie to the public. So if you look at the tax rate tables for 2018, you'll see that the tax rate for a millionaire is 37%. So somebody might say, well, how much tax does a millionaire pay? 37%. But if you look at the details, no millionaire who is not an idiot pays 37%, okay? So it's very easy for politicians to throw out these data in ways that sound right, sound okay, but really are not correct. Fairness is really tough, because if you talk to different people, they'll have different ideas of fairness. So I'm not going to be able to say, here's Lee's proposal for fair tax, but I will talk about some ideas about what makes a tax fair or not. So here's a graph I'm going to fill in a couple ways where income increases this way and your tax as a percentage of your earnings goes up on that axis. So if you look at the North Carolina state tax right now, we have what's called a flat tax or a proportional tax, which means that everybody pays the same percentage of their income. That's what a flat tax means. So it looks like this. I say that about the North Carolina income tax. That's new in 2017. Okay, I'll get back to that. Now, another kind of tax is called a regressive tax. So in a regressive tax, people with lower income pay a higher percentage of their earnings in tax than people with higher income who pay a lower percentage. So that's a regressive tax. And you might think, who would want to implement a regressive tax? Nobody would want to do that. But I'll show you that we have some very regressive taxes. And finally, taxes called progressive, where people with lower incomes pay a lower percentage of their tax, and people with higher incomes pay a higher percentage of our tax. Okay? The federal income tax system, in some ways, is a progressive tax system, because the higher your earnings, the higher the percentage that you pay. But I'll explain to you that that's not quite true. But for now, you can think of it that way. So I'm going to use these words, flat tax or proportional tax for the flat one, regressive and progressive as we go through. So I said what we're going to do is we're going to follow the money. So this is a graph that I put together of the major federal taxes and the major state taxes nationwide. So if you see an F, like individual income tax, F means federal, and there's individual income tax, S means state. And these are estimates of the total amount of those kind of taxes paid nationwide per year. So you can see the individual income tax is, $1.7 trillion a year is paid in federal individual income tax, and about 900 billion in Social Security payroll tax, et cetera. And so what I decided to do, because we don't have infinite time, is I'm going to talk about the biggest three taxes. All right, so these are the ones that we'll talk about more. I will say that the data I use for federal comes from the 2019 federal budget, and the data I use for state comes from 2015. So there's a little bit of discrepancy, but the idea, I think, is quite correct. So let's look at the Social Security payroll tax. This is what that graph looks like. So everybody pays 6.2% until you reach $128,400 of earnings. That's the 2018 number, and it changes. And if you earn more, you don't pay any more tax. So what that means is as you earn more money, the percentage of your earnings that you pay goes down. So you can see if you make $10 million, I don't know what this number is, but it's pretty close to 0%. Whereas if you make $10,000, you pay 6.2%. So that is a regressive tax, okay? So there you have it. There's the first regressive tax we're going to talk about. And everybody pays it. So very simple, but extremely regressive, all right? So let's talk about sales tax. So sales tax is complicated because every county, municipality, state has some kind of sales tax. It varies. In Orange County, our sales tax is 7.5%. That consists of, I think, 4.5% of state, and there's county, and then there's also a transportation 0.5% tax. So it adds up to 7.5%. There's a lot of variation across the nation on what sales tax covers. Mostly it covers everything you buy, but some places exempt food, some places exempt diapers. You know, there are just different variations on it. But the idea is that you pay a tax on everything you buy. So that seems kind of like a flat tax, right? You pay 7.5%. But remember, the definition is not percentage of what you buy, it's percentage of your earnings. So in real life, lower earning people spend most of their earnings, okay? Which means that the sales tax is applied to most of their earnings because they're spending most of it to live. Whereas high earners spend a lot less of their earnings, which means that the sales tax is only applied to a small part of what they earn. That is the part that they spend. And so their tax rate as a percentage of earnings is down. So this is actually a regressive tax. And so there's some data that estimates what percentage families pay in different states. So this is the chart that I took from some data for North Carolina. So you can see that people in the lowest 20% of earnings pay about 6.1% of their earnings in sales tax. And if you go out, you see the trend. You know, people in the fourth quintile paid down to 3.8%, and people in the top 1%, they only pay 0.9%. So this is a regressive tax. So message here is everybody is affected by Social Security tax, everybody is affected by sales tax. They are both regressive taxes. So these were nice because they were simple, and you can understand them easily. Now we are going to go to the federal income tax system, which is the largest source of revenue. It's the largest tax across the country, is the federal individual income tax. I do want to make one other point. If you think back to that graph where I showed the follow the money, we have a lot of discussion about corporate income tax. The reality is corporate income tax these days is very small in terms of the amount of revenue it contributes, okay? It's been declining, but in comparison to individual income tax, it's quite small. So let's look at, here are the tax brackets. These are for married filing jointly, and you can see that, you know, there's a table, and if you earn up to $19,050, you pay 10%, et cetera. Over $600,000, it's 37%. So the highest rate, the rate that you pay on the next dollar that you earn is called your marginal tax rate, right? So if you make, say, $610,000, and then you make an additional dollar, you're going to pay 37 cents of that additional dollar. So that 37% is your marginal rate, okay? So you know, isn't 37% seems pretty high? A lot of people say it's pretty high. But if you go back to the 1950s, the top marginal rate was over 90%, okay? So in a time when the economy was booming, we actually had very high marginal tax rates. It was okay. So it's been a long-term trend down on the top marginal rates. It took a big drop around the Reagan years. You can look, this is all this information is available online. But no, it's really not very high historically. And then you ask a question like, okay, so suppose you have a couple and they earn $250,000. What percentage do they pay? Well, you might say, okay, well, right, 24%. But that's not right, because what actually happens is they pay 10% on their first $19,500, then they pay 12% on this part, and then they pay 22% on this part, and then they pay 24% on this part, and if you do the math, they actually are paying 19.4% of their income. So you have to be, when a politician talks about the tax rate, you have to be very careful because most people are not paying what it says here, okay? So a millionaire is not going to pay 37%. They're going to pay less than that. So, really? Is that really what they're going to pay? Well, no. It's complicated, okay? So even though we had to go through all this and say this is kind of misleading, it's actually much more complicated. And the complications are very significant. So that's what I'm going to talk about next. So the first topic is I'm going to talk about deductions. And I'm sorry, but I have to introduce some jargon. Okay, so gross income is the amount of money like you would think you make, all right? So your gross income might be $200,000. So there are some deductions that are called above-the-line deductions, and they're things like contributions to an IRA account or health savings account, or if you're self-employed, your health insurance premiums can be deducted, or if you move for a job, the cost of moving can be deducted. I'll talk about the distinction between above the line and below the line in a minute, but say you had $10,000 in above the line deductions. Then you would come up with your adjusted gross income of $190,000. Then there are other deductions, which are the below the line deductions, which are things like home mortgage interest, charitable contributions, state and local income taxes, etc. And they add up to something, and you subtract that out, and you get something called your taxable income. Okay? So your taxable income kind of is what you compute your tax on. In other words, you take this number and you put that into that table to figure out how much tax you owe, right? So instead of putting $200,000 into that table to come up with your taxes, you'd put $164,000 into the table, and that's how you'd come up with your taxes. Except not really. It's more complicated, okay? Because some income is better than other income, and so it's a little bit more complicated. So, but I want to give you, before I get to the complications, I want to give you an example. There's some important concept here. Let's say that you have a $5,000 deduction. You pay $5,000 of mortgage interest on your house, okay? So if you have $100,000 in income, your marginal rate is going to be 22%. So you're going to save from your deduction, you're going to save 22% of $5,000 or $1,100. Now, let's say I have $700,000 income instead of your $200,000, and I have the same $5,000 deduction. Well, I'm going to save 37% of that $5,000 or $1,850. So if this was a deduction for mortgage interest, what we're doing is the lower earner is going to pay $3,900 effectively after the tax break to pay their $5,000 of mortgage. The higher earner is only going to pay $3,150. Okay, so the higher the tax bracket you're in, the more a deduction is worth to you. So net effect is we subsidize the housing costs for higher earners more than we subsidize the housing costs for lower earners. So the point to remember is all deductions are regressive. because a given deduction is worth more to a higher earner than to a lower earner. So anytime you hear about a deduction, think about it as something that's regressive. Okay? So just so you don't think this is a little minor detail, okay? So there's a really good Congressional Budget Office report in 2013 that analyzes a lot of tax break things. And so the data I'm talking about is from 2013, but the numbers might vary a little bit today, but they're roughly right. So the deductions for these things, state and local taxes, mortgage interest, and charitable contributions were worth $186 billion, which was 1.1% of the GDP. So these deductions are huge, huge money, okay? And if you look at who gets the benefit of these deductions, it's very interesting. Of households in the top 20% of income, they got 80% of the benefit of the state and local tax deduction. They got 73% of the mortgage interest deduction, and they got 84% of the charitable contribution deduction. So we're helping the higher earners the most with these things. And if you look even more detail, you'll see that even here, the benefits flow mostly to the people in the top 1%. So deductions are regressive, and the way they're set up, they're used more by wealthier people because, you know, not many poor people have a mortgage, for example, okay? So it is important to understand how deductions work because they are big, big dollars. I'm going to skip some of the detail, but the below the line deductions, people often call them itemized deductions. You have to fill out a form. Most people in the country don't do that. In 2014, 30% filled out that form, Schedule A. But if you earn over $100,000, 80% fill it out. The below the line deductions are only available to you if you fill out that form. And there's something called the standard deduction, which if your deductions don't add up to the value of the standard deduction, it's not worth doing it. So a lot of the reason that people in the lower income don't get any value from these things is because they either don't have those things like mortgage interest, or they earn sufficiently little that their deductions, their itemized deductions, are less than their so-called standard deduction. Which in 2018, the standard deduction was, at the federal level, was doubled for a married couple to $24,000. So most people, even more people, will not get any benefit from those deductions. I'm going to skip the other stuff. If we have time, we can get back to it. The above the line deductions, you don't need to fill out the schedule. They're always worth doing, but poorer people don't get any benefit because they can't do these things. It's like contributing to an IRA, having a health savings account, et cetera. So the reality is that these things are best for people who earn a lot. Deductions are, I think, one of the most opaque parts of the tax code. They're very hard for people to understand, and most people in the country don't have deductions, so they don't know about this stuff. So when I say opaque, you know, the politician says, wealthy people pay 37%. And somebody says, wow, so if a millionaire pays $370,000 in taxes, that's not bad, that seems fair. But, you know, as we already talked, 37% is only the marginal rate, and then you have all these deductions. And not only do you have the monetary impact, you have the complication impact. The instructions for filing for the mortgage interest deduction are 17 pages long. Okay? Schedule A itself has 18 pages of instructions. These things are complicated. Okay, so another kind of tax benefit are called credits. Credits are different than deductions because you subtract a credit from the amount of tax that you owe. So if you go through and you compute your tax with all your deductions, et cetera, and it says you owe $20,000 in taxes, but then you have a $2,000 tax credit, you now owe $18,000 So that's the way they work. And there are, in the federal tax code right now, there are 19 different kinds of credits. Here are some of them, doing energy efficient stuff on your house. There's a thing called the Earned Income Tax Credit, which is primarily of benefit to relatively poor people who are working. And it is a very successful way of helping low-income people who are working. And there are others, obviously, there are 19 of them. The interesting thing is that credits can be progressive. Okay, so they don't have the property that $1 of a deduction is worth more to somebody in a higher tax bracket than $1 of a deduction is worth to somebody in a lower tax bracket. All the credits are worth the same because they're taking a dollar credit is taking $1 off your tax bill. Okay, so that's good. The issue comes up with what happens if you have more credits than your total tax bill. So you could end up, and this happens with the Earned Income Tax Credit, you might end up that a person has little or no tax obligation and you give them a credit. The question is, do you give them the credit in cash, or do you say, wow, you had a credit but you didn't use it, so haha, you lose it, or how does that work? Well, so there's refundable credits, and the Earned Income Tax Credit's an example where if it's larger than your tax bill, you actually get money back. So you can actually send money to people through the tax system that way. There are non-refundable credits, things like the dependent child care, it's actually dependent care credit is non-refundable. If your credit is more than your tax obligation, too bad, you lose the excess. And then there's some credits that are called carry forward, where let's say you have a $5,000 credit but your tax obligation is $2,000, so you take the $2,000 credit, you owe no tax this year, and next year you have a $3,000 credit carried forward. Residential energy credits are like that. And then there are some that are in a complicated way partially refundable, like some of the some of Obama's tax policies during the recession. So the point here really is credits can be progressive, but it depends on how they're formulated as to whether they are progressive. And I'll come back to that in a minute. So I have, two more topics to talk about in this federal tax discussion. And so the next topic is exclusions. So there's some stuff that is excluded from taxation. All right, and this gets a little, these topics get a little hard for some people. The biggest one is employee-sponsored health care. So if you work for a large company that still helps you with your health care premium, nobody pays taxes on that money. And in the 2013 data, that reduces federal revenue, that exclusion reduces federal revenues by $248 billion, that's billion dollars. So that's earnings that people get that is never taxed. And I can assure you, most of that benefit goes to higher earning people. People working at McDonald's don't get a great health plan that is tax-free. Another one which also helps more well-to-do people, there are exclusions of pension benefits and pension earnings from taxation. And usually what it means is you don't pay taxes now, but then when you retire and you actually get the money and spend it, you pay taxes later. So you might have 30 years of tax-free growth of your earnings, okay? And that, by delaying those taxes, that reduces federal revenues by $137 billion. And here's one of my favorites. If you buy a house and it appreciates under a certain set of circumstances, which most people meet if they live in the house, you can exclude up to $500,000 in the increase in the value of the house from taxes. And you can do it every 2 years. And it's one of the reasons that owning a house has long been a path to becoming more into the middle class and upper class, because your house can appreciate in value and you don't have to pay taxes on that appreciation. People who don't own houses or can't own houses don't get this huge benefit. It's a really big one.
Lee,
Yes?
so when the taxes are delayed on pension contributions when you're 65, is that money, is it all taxed, or is it just the interest that you've earned taxed? Or is it both?
It depends on the kind of retirement plan that you have. So there's Roth plans, there's IRA plans. It's complicated. I don't want to get into it. We can talk offline if you want. But it's a very big benefit. Ava?
It's also useful to mention that then when you finally do pay the tax, you're retired, so your income is much lower than it was when you were earning.
Yes, that's the hope. I mean, that's the hope. What you don't know is what the tax rates do, right? So, somebody who's young today, when the tax rates are low, might be better off paying the taxes now if we start increasing tax rates down the road, and when they retire, the tax rates are higher. It's kind of hard to predict. But the thing that's totally predictable is that since you don't have to pay taxes on your earnings every year, you have more money to invest, and so your money grows faster than it would otherwise. So that's the biggest part of the tax break. But historically, what you said is correct, but it may not stay correct. Okay. Another one is capital gains on assets transferred at death. This is called the step up in basis. So I buy some stock, and my stock goes up $100,000 in value. So let's say I buy my stock, I pay $50,000 for my stock, and I keep it for a long time, and at the time I die, it's worth $150,000. So there's a $150,000 gain on it. And my stock goes to one of my kids. My kid gets to say that the basis of their ownership of the stock is $150,000, not the $50,000 I paid for it. So nobody ever pays taxes on the $100,000 of gain that I had in that stock. It's another very powerful thing that helps people who can invest in things like stock and homes, etc. So, and there's more. I want another one that annoys me is people who get stock options. There are some really good tax breaks related to stock options, both for the company and for the person. It's complicated to explain, but they're there. And there's others, but these are some of the common ones. Most people don't know about this stuff, right? So politicians don't have to kind of defend it. Okay, so that's exclusions. These are things that you don't pay taxes on. Then the final topic is preferential rates. So preferential rates is what it sounds like. Certain kinds of earnings are better for you than others. So what are called long-term capital gains, that is, gains in appreciation of stock or other capital assets that you hold for more than a year, that's what long-term means, and what are called qualified dividends, which most dividends that you get on stock are qualified dividends. They have long received preferential rates that are tied to what tax bracket you're in. The tax changes for 2018 have decoupled it from the brackets, from the regular tax brackets. There are now just tax brackets for the capital gains and qualified dividends. And for 2018 to 2025, yes, you read that correctly, the Tax Reform Act just puts it in for those years. Married filing jointly has 3 brackets. So you can see that if you make up to $77,000 as a married couple, you don't pay any tax on your capital gains. If you make over $479,000, you pay 20% is your marginal rate on your capital gains. Think back to the chart. For ordinary income, you pay 37% of marginal tax rate. So capital gains are treated better than ordinary income. So a person who works for a salary pays the higher rates for their salary. A person who earns their money by investing in stock and having the stock appreciate or having dividends from the stock pays a lower rate on their earnings. That's one of the reasons that you hear about, you know, the Warren Buffett saying he pays a lower tax rate than his secretary. It's because, I mean, there's probably a lot of things, but a big part of it is because he earns his money from capital gains on investments, which is taxed at a lower rate than the secretary who earns a salary, which is taxed as ordinary income. So this is an example of a preferential tax rate. So now I want to talk about the big picture, or what are called tax expenditures. And this will connect back to the things we've been learning so far. So this is the definition. This is from a Joint Committee on Taxation from Congress. Basically what it says is that these special tax breaks cost the federal government revenue, right? Because people are not paying taxes on all of what they're earning. And that lost revenue is just like an expense. It's just like if we appropriated, we're going to spend money to encourage people to buy stock, and we're going to pay them to own stock. Well, that's kind of what the tax break on capital gains is. We're paying people by reducing the federal revenue to own stock. And these tax expenditures, they increase the deficit just like expending money does, right? We need to spend money to cover these tax expenditures. So the quote here is that tax expenditures are similar to direct spending programs that function as entitlements to those who meet the established statutory criteria, okay? These are not, you look at the federal budget, you won't see any of these tax expenditures in the federal budget. They're not there. We pretend that we don't spend that money, but we are spending that money by just reducing the tax revenue we get from what people earn. So that's the concept of tax revenues. So does it matter? Well, yeah. So this is data from January of 2017 from the Congressional Budget Office. Here are the tax revenues from individual income tax. Okay, it goes up to, this is in percentage of the gross domestic product of the country. So this is about a little less than 9% of the GDP of the country is the size of what the federal government gets from individual tax revenues. Payroll tax revenues, which are things like Social Security tax, Medicare tax, they're smaller, about 6% of GDP. All other revenues, you can see down here a little less than 4%. Tax expenditures are this bar. So tax expenditures are roughly equivalent to the size of the individual income tax. So if we didn't have these tax expenditures, roughly speaking, we would bring in twice as much money for a given tax rate than we do now. So it's a huge big deal. We're essentially spending more than 8% of GDP on tax expenditures that don't appear in the budget, that are not appropriated by Congress directly. They're put in as tax breaks in our tax system. So this is a big deal. Just for comparison, here's defense spending. Okay, so the tax expenditures are bigger than defense, bigger than Medicare, bigger than Social Security. So you hear all the politicians talking about, well, we got to cut Medicare, we got to cut Social Security because we can't afford them. Well, tax expenditures are much bigger, and I'll show you some really interesting data about these tax expenditures in a second. So the largest tax expenditures are the exclusion from tax of employee-provided health care insurance. That's the biggest. And it's in two parts. One part of it is it reduces the income tax, and the other is it reduces payroll taxes that are paid. The next one is the pension stuff I talked about. Then there's the preferential rate on capital gains and dividends. And then there's some stuff about corporations that stash money overseas. And then finally, there's the deduction for state and local taxes. The point is that these things are a big deal. They really matter. okay? And the numbers here are percentage of GDP. So they're very significant. Well, the Congressional Budget Office did an analysis in 2013 to look at who gets the benefit of tax expenditures. So they took the 10 largest tax expenditures and they analyzed who gets the benefit. And so they did it by quintile. So households with the bottom 20% of household earning all the way up to people in the top 20% of household earning. And you can see that it's about 51% of the benefit of those tax expenditures goes to the people in the top quintile, the top 20%, okay, of earnings. And if you look at more detail, these colors show you this is the top 1%. So you can see the biggest benefit goes to people in the top 1%, and somewhat smaller, this one is 81st to 90th percentile. So the message here is tax expenditures are really big, and more than half of them flows to the people in the top 20%, which is pretty striking. Okay, so that's kind of the lesson about how it works. So let me switch gears and talk about the income tax amendment, and we now have the vocabulary, I think, to understand why it is bad. So, first of all, let's look at the top marginal rate of North Carolina state income taxes over time. So here is the top marginal rate all the way out to 2019 because the tax rate's already been declared for it. And so you can see what's happened. For a long while, we were like 8.25%, and then it kind of went down a little bit, and it was a little less. It was like 7.75%. And then something happened in our legislature. I don't know what, but something happened, and they took the tax rate down to 5.75%. And it's been going down, and next year it'll be, I think it's 5.25 or something like that. Okay, so that's the top marginal rate for North Carolina state income tax. So this here is the current cap. There is a cap in the North Carolina Constitution of 10%. So here it is. I don't really know how long that cap's been in place, but let's just assume forever. But you can see there's a pretty good amount of headroom, so that, you know, if we had, you know, a terrible disaster and we needed to raise more money, there would be room to raise the income tax a little bit as a way to raise that money. Okay? So along in 2017, our friends in the North Carolina Senate, encouraged by Americans for Prosperity, which is the Koch brothers organization, said we need a tax cap. And it ought to be here, 5.5%. Okay, so a bill was passed in the Senate for a 5.5% tax cap. Fortunately, it was not approved in the House, so it didn't go into effect. But just to let you know what our Senate legislators, our senators, were thinking, at least in 2017. So what they actually did now is they passed this amendment at 7%. Okay. So it's really interesting to look at this, because it says that we're going to put in our Constitution a cap on income tax that is lower than our income tax rate was for most of this century. So if we need to raise more money, like to have decent public schools or whatever, this is going to come into play pretty quickly, okay? And it's bad. For that reason, you know, you need revenue sometimes unexpectedly. So this cap, while it's not as bad as what was originally proposed, is still bad. And now I want to connect back to the other stuff that we talked about. So if you're not allowed in the Constitution to raise the income tax back up to where it was for most of this century, and you need to raise money, well, what can you do? Well, you can raise sales taxes. But what did we learn? Sales taxes are regressive. So this is a way of shifting the burden to poorer people, because if we raise sales taxes, poorer people are going to be the ones who are going to get hit the hardest by raising sales taxes. This is why the income tax amendment is so bad. One, because it eliminates the flexibility of raising revenues if we need it, like we have massive hurricane damage, or, there are lots of things that can happen. Or we wake up and say, modeling ourselves on Kansas was not such a smart idea. Our schools are falling apart. Maybe we need to raise the income tax level and fund our schools again. Whatever it is, if we have this cap in the Constitution, it's going to be really, really hard to respond with anything other than raising sales taxes, which is a disaster for lower income people. Okay, so now to the final part of the talk, which is, what do I think we could do to improve our tax system? So I really have to qualify this. If I was a dictator, I could put some of this stuff into effect, but in real life, there are lots and lots of compromises that have to be made in constituencies that have to be worked with, and frankly, I don't know how you do that. But I will put out some ideas, and I think one of the things that will become apparent is, to make any of this happen, there has to be some compromise. Some things that conservatives like will have to be in the tax system, and some things that progressives like will have to be in the tax system, and it's going to have to be figured out how you do that. But these are the kinds of things that I would call real tax reform. So let me go into that, and I'll try to wrap it up in 5 to 8 minutes or so. So the first thing is, those of you who have read or heard of George Lakoff's work on framing, we have to change the way we discuss taxes. The current framing is government's big, government's inefficient, cut spending. Okay? Reduce tax rates, and the economy is going to grow, and jobs are going to grow, and tax revenues are going to go up, and we've seen over and over and over again, that's a lie. And then Rebecca will hear this. Anytime you talk about, well, let's give health care to our citizens, how are we going to pay for it? We can't afford, whatever it is, we can't afford it. How are we going to pay for it? And then you hear, sometimes not stated explicitly, but kind of in undertones, these entitlements for those poor people, or those sick people, or those old people, or those brown people, whatever, those entitlements are killing the economy, and that's why unemployment is so low. Okay? These are all part of the framing that exists about taxes now. So I am particularly incensed about all the talk about we can't afford to help poor people. So I put together this chart. Who gets welfare? Okay. So on the left is what people might call welfare for the poor. So there's SNAP food stamps. Federal government spends $76 billion a year on food stamps. There's temporary assistance to needy families. Federal government spends about $20 billion. And I did say to you that tax expenditures, about 51% goes to the top 20%. But interestingly, significant amount of money flows to the lowest 20%. Most of that's from the earned income tax credit. That's $74 billion. So when I add this up, I get that we spend about $170 billion on what you might call welfare. Now let's look over here for the wealthy. And I took the tax expenditure data and applied the 51% that flows to the people in the top 20%, and I computed that we spend $472 billion on welfare for the wealthy. So, the framing is a lie. All right, okay? So, the reality is that a lot of tax expenditures are entitlements for well-to-do people, and that most of these tax expenditures fly under the radar. Nobody talks about them. Can you imagine if we didn't have preferential rates for capital gains, and a politician had to go and stand up in Congress and say, I propose a bill where we're going to pay high-income people to invest in stock and make profit on the stock. We're going to pay them to do that. We're going to pay them $150 billion, we're going to spend to encourage high-income people to buy stock. That would never happen. But it happens through the tax system because most of us don't understand this stuff. So we have to reframe the discussion, we the progressives, and make it not about tax cuts or the holy grail. What we need to do is something along these lines, and I'm certainly no expert in how you do framing, but taxes fund important services for the public and they help people in our society who need help. Our tax system should distribute the burden fairly, whatever that means, and it should be done in a way that people can understand. Everyone should pay, and the most fortunate people among us should share more of their income to support the services and investments that we all need to be one country. And as the most prosperous country in the world, by far, we can afford to provide quality education, health care, and economic opportunity to our citizens if we share the cost of doing it in a fair way. I think some kind of framing like that where we get people to understand that taxes are not an evil necessarily. Nobody likes to pay taxes, but taxes can do good things for our communities and our country. And we need to change the framing to be more about that and less about cut tax to grow the economy, blah, blah, blah. So, final part is ideas for improving our tax system to make it more progressive. So let's start with one of the most regressive taxes, Social Security tax. Well, this is so simple. You get rid of the $128,000 400 tax cap on income that's taxed, and it would solve all the Social Security financial issues that people bring up. It would make the Social Security tax flat or proportional, and it really would be, no joking. And we could either increase the benefits or we could lower the taxes for everybody on Social Security and keep the same benefits. But we'd have that option. Then later, so I would say, do this as a first step. Then later you could talk about, well, maybe we'll make Social Security tax not flat, but be somewhat progressive. But that's a later discussion that could allow you to have either lower broad-based taxes or benefit improvements, because we know that people are living longer than they used to, and we need to have more money to support them. So that's the obvious thing. Lots of people have said this. It's just so obvious, but we don't seem to do it. Okay, so the other really regressive tax is sales tax. I think that we won't get rid of sales tax. It's kind of ingrained in our whole culture that you pay sales tax. But I think we could reduce sales taxes over time. Now, the problem with doing that is that it reduces revenue. But you could compensate by increasing income taxes. And you can do this at the state and local level. If the state North Carolina portion of our sales tax is, I think, 4.25%. Suppose we made that, 3.5%. You could figure out what you'd have to do to the income tax to raise that lost money. That's not hard, all right? So as we reduce the sales tax, we're lowering the regressive tax, and we're using a more progressive tax to replace that lost income. Again, this seems pretty obvious, but we don't do it. Okay, and then this is what I think is the really hard part. We are using our income tax system to subsidize various behaviors. We subsidize buying a house. We subsidize investing in stock, et cetera, et cetera. So first of all, deductions are always regressive. Get rid of deductions. If we want to continue subsidizing the same things, subsidize them with credits instead of deductions. Because credits, especially fully refundable credits, can be progressive. And the other thing is change what we subsidize. So we subsidize housing for well-to-do people by subsidizing the cost of a mortgage. What if we said, no, let's not subsidize mortgages, let's subsidize housing for everybody? We could do that. So we'd go from a system now which subsidizes wealthier people buying houses to a system that subsidizes everybody for housing. If you pay rent, We could subsidize. So you could do those kinds of things. I would like to see us get rid of a lot of those subsidies, but if we're going to have them, let's do them in a way that it is helpful to more people. There's some technicalities about how you do income-based phase-outs of credits. I'm going to skip over that. We don't have time. It would be really great to eliminate preferential treatment and exclusions. So these are the big ones. And as I wrote here in italics, these would be wildly unpopular. Okay, you saw what happened. President Obama tried to take away the tax break that you get for investing in 529 college plans. And there was immense pushback from the financial industry and from a lot of people, and he had to back down. Okay, so this is an area where I think the pushback would be tax increase, tax increase, tax increase. And so you'd have to figure out how you would offset these increases by a broad-based tax reduction. But these things are a big part of the tax expenditures that we have, and they really distort our the way that we view what we're subsidizing. Okay, because these are big subsidies for mostly well-to-do people. And then there's simplification is another really important thing. So every time you have a subsidy, you have rules, and you have an organization. Think about charitable contributions. There's a really nice thing. We should all contribute to charity. But look at all of the problem we have, because first of all, you got to define what a charity is. And then, you know, we get into, well, some charities are religious and they want to discriminate based on this or that. And the government gets involved in all of this stuff of determining what's a valid charitable contribution. And there's a huge bureaucracy around that. And for every subsidy, you know, I talked about how many pages are in the instructions. Every subsidy has these kinds of rules, and they're often inconsistent. I learned when Ava and I moved from the West Coast back here, we used the exclusion of capital gains on your house. I didn't go through all the rules, but you have to live there a certain amount of time. But if you don't live there that much time, you can prorate it under certain conditions. And one condition was you move for a job. And I was moving to come here, and I started a consulting business. So in that part of the tax code, self-employment as a consultant qualifies as moving for a job. But in another part of the tax code, the qualification for moving for a job is different. You know, it's just complicated. I think fully refunded tax credits could remain a mechanism for giving subsidies to people rather than having other bureaucracies. But to the extent that we can eliminate these kind of tax-based subsidies, I think, you know, will make our tax system much simpler. Likewise, preferential treatment. You know, I talk about preferential treatment of capital gains and qualified dividends. If you look at the tax forms, it's tremendously complicated what you have to do because of different money getting taxed in different ways. I won't go into the details, just take my word for it. It's very complicated, and there's lots and lots of legislation about it. And then finally, we haven't talked about it at all, but there's something called the alternative minimum tax. It's been in place since like the 60s. What happened is there was, I think it was a treasurer of the United States or somebody in the Federal Reserve or something like that, put out a report and said, the 158 top earning people in this country pay no tax. And at that time, people went, oh, that can't be. And so they put in this parallel tax system called the AMT that was designed to force people who can evade taxes through all these kind of mechanisms I just talked about to actually have to pay taxes. So if you earn enough money and you use enough deductions, you will have to compute your alternative minimum taxes. And because it was never inflation index, more and more people in the country actually have to pay this alternative minimum tax. And it's very complicated. It's very hard to estimate ahead of time whether it's going to affect you and how much it's going to affect you. And Congress is constantly tinkering with it because everybody hates it. But they haven't really gotten rid of it, although they have started inflation indexing it starting this year. If we eliminated the tax preferences that cause people to be able to evade paying reasonable tax rates in the first place, we wouldn't need the AMT and we could just get rid of the mess. But we'd have to get rid of the tax preferences, first of all, to do that. So those are some ideas on how we might be able to simplify taxes. Like I said, getting all this stuff passed, it's a small detail. So in summary, our tax system is enormously complicated. I think by any reasonable definition of fair, it is unfair. There are many vested interests in this system. The financial companies are all in it. The people who are subsidized are all in it. It's, like if we said, we're going to eliminate the exclusion of taxes on earnings in pension plans, all the companies that are in the business of selling 401ks and IRAs, et cetera, they're going to push back because that's one of the reasons that people put their money in those kind of investment vehicles. So finding the way to do this politically, that's a huge challenge. I think that it can only happen, short of a revolution in the country, that just wipes the slate clean. I think that these changes have to be made over time. They have to be packaged in a way that multiple people feel that they benefit. So, you package a loss of some preferential treatment with a reduction in overall tax rate or something like that to make it so that you can have compromises and actually get something passed. And my message to us progressives is this is an area where we have to compromise our principles if we're going to make any progress, because we're going to have to give something to the conservative-leaning people so that they see some benefit to these changes, not just as progressive, we get what we would like to see happen. So that's all I want to say. I will tell you, I blog on this stuff occasionally. You're welcome to look at it. Rebecca's making a video, and we'll make it available. I'll make the slides available on my site here, and you're welcome to have at it. So thank you very much for your attention, and I'm open to any questions.
As the federal taxes, they try to reduce them, or hopefully not too successful at that, but they're basically saying we're not going to help out the states. We want the states to do their own fundraising and decide how they're going to spend the money. So it seems to me that's another reason that 7% is a problem. If the federal rate goes down, the states are under pressure.
Yeah, so this is my stock answer. It's complicated. As far as I'm aware, all states base their state income tax in some way off of the federal income tax. So like in North Carolina, you do your federal income tax, you go through all your deductions, et cetera, and then you put that information in your state tax, and there are some adjustments, like, let's see, for federal taxes, you can deduct your state taxes that you pay, but you can't deduct your state taxes that you pay from your state income tax, stuff like that. There's interest from treasury bonds is not taxable at the state level, but is taxable at the federal level. So there's an adjustment for that. So there's a bunch of adjustments, and different states do it. I talked about above the line and below the line, and different states work off of above the line or below the line as their starting point. But all states are affected when the federal government changes its tax policy, and in some states it raises revenues, and in other states it lowers revenues. So
And there are
just,
some states that do not have a state income
Yes.
tax, like Florida, and I believe that's come up in the debate, at
Yeah.
the governor's debate in Florida.
right. So the comment is there are some states that don't have a state income tax. There are, I believe, 7 such states. So it's Florida and Texas and Washington,
Tennessee,
Nevada.
Nevada. One of the New England states. I think it's New Hampshire. But the comment I would make is, like I showed that chart of how regressive sales tax is in North Carolina. If you would take that chart for one of the states without income tax, it's much, much worse because they're not raising any money from income taxes. So all the money they're raising comes from sales taxes and excise taxes. I haven't talked about excise taxes, but excise taxes are things where you pay an amount per unit of what you buy. Like most states have an excise tax on gas, and you pay a certain number of cents per gallon for gas. That's another very regressive kind of tax. So if you look at the regressivity, if you will, of states, of state taxes in states that don't have an income tax, it's much worse because all the money is raised from sales taxes and excise taxes. Yeah, Kim?
I have, of course, it's almost more of a comment, but it seems to me that virtually everybody that's an economist or an accountant, they take Econ 101, and somewhere in there is this theory, it's a man's name, that at first, money accumulates at the top, and then after a while...
Yeah, the Laffer curve.
Laffer curve, and another word for that is trickle down. And people that believe in that, there's nothing you can tell them.
Right. So it's a good comment, and I would think that at this point, there are almost no respectable economists who believe in the Laffer curve anymore. Just politicians who have an agenda. It's been shown over many decades that it just is not true. And I think...
Still teaching it in the school?
I don't know. I don't know.
Laffer is.
Yeah, he's still very active in this. Tony, you had this won't reach if you want to come up or if you want to yell.
I think I can scream enough that everybody can hear. I just sort of might add to your presentation if you add in that on the one hand you have these particular exclusions or whatever, the tax expenditures that are promoting behavior like buying taxes or buying bonds, and there's no sales tax on those. None. So, if somebody can buy $1 million of tax, they don't pay a single cent in a sales tax on that.
That's true.
And I think there's things like they create investment vehicles for when they buy private aircraft, like jet business aircraft.
So, look, the real point is I scratched the surface. I said at the beginning that there's a figure that's floating around on the internet that there's 76,000 pages of stuff in the tax code, and I think it's pretty well understood that that's not an accurate number, but whatever it is, it's a big number, and I did not cover all that tonight. And I don't know all that, and I don't want to know all that. So I mean, literally, I tried to look at the data and look at the things that are the biggest. And so, yeah, there are special breaks for all kinds of things. One of my favorite parts of the so-called tax reform law is there's a whole section on how you value fruit and nut trees, depending on when they were planted, what kind of fruit, and what kind of nuts they are. And this has to do with valuing these assets for businesses. It's in there. I mean, so we have this kind of stuff in our tax code, and it boggles the mind, but I don't know all that stuff. I just don't. Yes, I'm sorry, I don't know your name.
My name is Denise. Assuming that Trump is paying no taxes, how is he getting by with that? And is he doing so totally illegally, or is it legal, or?
So the question is, assuming that Trump is paying no taxes, how is he getting by with it? Is it legal or illegal? And so I have not seen his tax returns, so I don't have any information. I mean, there was an article in the New York Times like 2 weeks ago that talked about how he might do it. It involves using depreciation in his business to build up losses that he then transfers to his individual tax, his personal taxes. And so for many years, he can balance whatever he earns against the losses that he gets that way. I don't know the details, and I don't really know whether it's legal or not. I just know what I read in the New York Times. Yeah, Susan.
Maybe just expand on that a little. Yes.
find the New York Times article. I think it was October 8th. I was just sending it to somebody. Oh, thank you. I was just sending it to somebody today. And a lot of it had to do with a very shady appraiser. A lot had to do with very shady people along the way who said this apartment building isn't worth $5 million, it's worth $700,000.
Yes,
So
that
there
was
was
an article.
So we think that the article really has a lot of detail. It has his father's whole setup and how and how Trump messed up his father's business. It's very interesting.
So I would like to make a comment
There's
on this.
also a very interesting New Yorker article.
Yes, there's
Yes.
a New Yorker has a very interesting article, but I would encourage you not to focus on that. I mean, the things that Trump did or is alleged to have done that allows him to pay little or no tax, to the extent that that's technique that works commonly for lots of people, it's interesting. But otherwise, just because it's Trump, to me, I'm much more interested in this kind of stuff because this affects most people in this country. And so I view some of this sort of intense interest in Trump's financials as yet another way that he distracts us from the important negative things that are going on in the country right now. So I really have not tried to understand it any more depth than those two articles. Yeah, Felix.
This is maybe multi-part, whatever. Could you comment perhaps on the so-called fair tax plan that's been advocated by certain conservative groups?
Yes.
And to sort of follow up on that, why aren't progressive groups proposing such an alternative?
So the core idea of the so-called fair tax plan is to have a flat rate tax. That's the core idea. And so it's not a progressive tax plan. It's a way of saying everybody's going to pay the same percentage. And various versions of these proposals say various things about the various deductions. In general, they're opposed to a lot of those deductions. But so a lot of people wouldn't consider it a fair plan, and certainly a lot of the vested interests don't consider it a good plan. So I think a lot gets back to we have to reframe the discussion and have it in that context. There was another question. Yes?
Yes, my name's Amy. I appreciate your talk because I actually do my own taxes for years, but this year I'm giving up. Because after the tax cut, I just can't keep up.
What tax cut?
Whatever just happened.
Oh, the tax scam act? Yeah, okay.
So my question to you is, most of my stuff is, my income is from the W-2, but my concern is this cap on Social Security, and why don't progressive just ask for one line in a bill to remove the cap on Social Security and pass that? I just don't understand, because it seems to me we should just focus on what we can get.
Right. So it's a good question. Let me first address how complicated it will be for you to do your taxes. Probably it'll be simpler. I mean, unless you make a lot of money and have a lot of different funky investments, it'll probably be simpler this year than in the past for you, because the standard deduction for married couples and also for individuals was raised quite a bit. Like I have filed Schedule A itemized deductions for essentially my entire working life, and I'm old enough that it's a lot of times. I probably won't do that anymore because the standard deduction will be larger than all that stuff. So
I think I'm on the bubble. I've actually hired an accountant for this.
okay, I mean I can't comment on that, but I'm gonna try to use TurboTax again like I've done for years, and I think it will actually be simpler. But back to your question about the income cap on Social Security. When Social Security was passed, it was sold as kind of like an insurance policy, and everybody pays in and everybody gets out, and your money's going into this pool, and it's going to be there when you need it. Okay, that was probably a fiction back when it was sold. It's definitely a fiction now. In all reality, my kids are going to be paying the taxes that will pay my Social Security. The money that I put into it is not going to be sufficient because I'm going to live a lot longer than anybody thought I would. I hope I'm going to live a lot longer than anybody thought I would back when I started working. And so if you want to look at the reality, Social Security is a tax like any other tax now. We're funding a program. It's not really a separate thing. Money has been moved out of the Social Security Trust Fund for other needs. So it's all a fiction, but as soon as you start saying we're going to remove the cap, then the argument's going to be, well, you know, I make $1 million and my benefits are not going to be any bigger than the benefits of the person who makes $128,000. So why should I pay more tax? Because it gets back to the idea of, are we a community and do we help each other, and people who have more help more. That's, I think, the stumbling block. Other questions? Renee?
So I have two. I know that you've been focused.
Well, you're close enough to,
I know.
sort of.
I know you've been focusing more on, at, you know, the federal level and state, but at the two things. One, tied in with the sales tax is a service tax, and I was wondering your viewpoint on that. For example, and I hesitate to say too much about it because I know that our delegation and state they did support it. But for example, when you go into a grocery store, if you buy Weaver Street's bread from their bakery, you have to pay service tax, which is much higher than if you just bought some other brand off the shelf. So that was number one. The second is that you didn't say anything about property tax, and I'm wondering how that fits in.
Okay. So what you're calling a service tax, it's just another kind of sales tax, really.
Oh, it is?
It's a sales tax at a different rate on a particular kind of good. And one of the things that happened when the legislature lowered the income taxes, they increased a whole bunch of what generally people call fees. So fees for getting driver's licenses went up. Fees for getting license tax went up. Fees for getting all kinds of permits. Like if you're a beautician and you need a permit for doing that, the fees will raise. All those things are regressive because.
Well, I was thinking more, as I said, like in the grocery store. To me, it seems a bit discriminatory because if you don't have a lot of money, you've got to get the loaf of bread that's on the shelf. You can't, get the one that's, that's at the, in the bakery, which is, just on the other side.
Well,
of the aisle.
it's choosing to make the price of certain things effectively higher than the price of other things.
Yes.
Okay, so sometimes we probably would say well, that's a good thing. It's probably a good thing that the cigarette tax was raised. Unless you smoke cigarettes, you think, well, this is really good because cigarettes are bad. But it's the same kind of thing. For people who spend a larger portion of their money to buy things as versus saving it or investing it, these kinds of things are regressive. They eat a larger percentage of their income than they eat of somebody who makes $10 million. And so one of the things the legislature did is they increased lots of those things when they lowered the income tax rate. You had a property tax. Property tax is also similar in the sense that property tax mainly affects more well-to-do people because you pay it on things like boats and cars and houses. And so if you don't have a lot of money, you don't have those things, you don't pay property tax. We subsidize property tax in the income tax system because you can deduct property tax from your federal income tax. And as we talked about, the more income you earn, the more valuable that deduction is. There's some complication introduced because there's now a cap at the federal level on the amount of property tax that you can deduct. I forget what it is, but it's like $10,000 or $11,000.
It's
10, okay. So, this is widely viewed as a way to punish blue states, which tend to be states that have higher property taxes. But whatever it is, that's the situation. We subsidize property taxes in the income tax system, maybe a little less than we used to, but we still subsidize property taxes, which means we subsidize the things that you pay property tax on houses, boats, cars in North Carolina. So, yep, yes?
Hi, I'm Bob. We talked a lot about the tax expenditures being a big problem, of being likely hidden. How can we bring those up so that they can be more visible, like having an alternate budget sheet that combines everything together?
That's a really good question. I would say that the first thing we need to do is find out whether our politicians understand this stuff. And if they don't, teach it to them, and if they do, get them to start talking about it. Because nobody's going to listen to Lee Nackman talking about this stuff. You know, but if we could get, oh, this is really a dream, if we could get Tom Tillis to talk about this stuff, you know.
Tony? That difference with you, I think you're wrong. I think people will listen to Lee Nackman talk about that. And I think part of the answer is this group, is we formed the Progressive Caucus of the Democratic Party specifically to try and get these topics to be discussed more in public debate.
Yeah, I agree with you, Tony, but I think it would be really even more effective if somebody who is known would start talking about it.
We'll make you know.
Okay. I mean, you know, like Bernie Sanders talks about this stuff, but he uses words like the tax system is rigged. And so people who don't want to agree with Bernie say, well, you know, he's just, it's hyperbole, or, you know, he's full of you know what. So I kind of feel like you have to talk about the real facts to get people to understand that, yeah, the tax system is biased in favor of well-to-do people. Rebecca?
So I just wanted to add to your reframing. What I like to say is that taxes are an investment in us as a country. It's a way to pool our resources to make our country better, like in ways that we couldn't pay individually, because, you know, helping people or whatever that need help is not going to convince certain segments of our society. But if we, you know, frame it as it's an investment in all of us, it's an investment in our country, I think that that's a little, you know, might be more palatable to some people.
I agree. It's good.
And I wish Bernie Sanders would use that.
It's,
We need to get these things in our schools too.
Mm-hmm.
Some more honesty in our schools about the realities that we are.
I would be happy to start with like evolution or you know, like science. But yes, I mean, I will say that you know, I have a lot of knowledge. Most of my friends are upper middle class people, and I have talked to many of them, and most of them don't know about this stuff. They're not interested. Their eyes glaze over, and I have not figured out a way to get them to pay attention long enough to explain the detail. Like, I spent all this time in this talk, you know, explaining what regressive, progressive means and giving examples, et cetera. And until I did that, you know, it's hard to understand what's going on.
And I got that somewhere in school, but I don't think many schools teach that.
Probably not. But getting people to understand this stuff would really be helpful. And again, I wish that somebody who knows how to do marketing and framing better than I do would try to do this, because I think it's a very important thing.
Good, and you should dedicate the rest of your life to.
Talk to my wife and see what she thinks about that. Thank you very much. I appreciate your attention.